Good afternoon, everybody, and welcome to another professional optics session here with the MGAA. Lovely to welcome you all again. I'm Manveen, I'm the Learning and Development Manager here at the MGAA. I'm sure many of you will have kind of seen me come across me in these sessions. I'm just going to cover a few housekeeping points before we do get today's session underway. You'll notice that you don't have access to your mics and cameras at the moment, but we will activate these later in the session so you can engage during the Q&A piece. But please don't worry if you can't turn them on at the moment. You've still got access to the chat and you'll still be able to hear and see the session. We do encourage and welcome questions, so please do ask them, but we will look to kind of cover these mainly in the Q&A piece, or if they come up in topic and during the conversation, I'll address them there. You'll notice that the session is also being recorded. This is so that we can share this with you post-session, and we'll get a link out to you, as well as a link to our feedback survey, which will also drop into the chat at the end of the session. If you find that this session meets your learning needs, you could also include it as part of your CPD log, so please do consider that if you find it supports your professional development there. We don't have permission to use any AI note-taking tools, so if you have got this activated or if any have made their way through to the attendee list, I will have to just take them out. That's all from me. I'm going to actually hand over to Claire from Lysander, who's going to be moderating and taking us through this session with Earnix. Over to you, Claire.
Thank you, Manveen. So I'm Claire Ruel. I am account executive at Lysander PR. I moved over from Insurance Times. I was in journalism for 10 years, covering technology and insurance. And today we're going to be looking at insurance pricing and how it has become a board level issue for MGAs this year. So welcome to this professional optics webinar. So since, I would say, early 2026, UK MGAs have been navigating a soft market, which brings about a new phase of market pressure, for example, increasing competition, lower premium rates, and easier access to capital. And to counter this, capacity providers have been increasing scrutiny, softening rates, and various regulations such as the FCA's consumer duty, reshaping expectations such as fair value, and easier access to capital. So pricing has actually emerged as a key lever for protecting margins and credibility. So during this session, we will draw on the Earnix 2026 Trends Report. And if you haven't downloaded it, it's a really interesting report, please do. And we'll be looking at industry benchmarks to explore how MGA pricing strategies are evolving in practice, as well as whether there are any gaps emerging between intent and execution. So I'd like to introduce my two panelists from Earnix, Andy Howe, who is Director of Insurance at Earnix, and Vince Valenzuela, Solutions Engineer at Earnix. And we're going to start off with a very exciting poll, actually. So could I ask for the poll to be launched? So the poll question is, what is the biggest driver making a board level priority for MGAs right now? And we have 4 options for you to choose from: soft market rates and margin pressures, increased scrutiny from capacity providers, consumer duty and fair value expectations, and need for better data and pricing governance. So I'll just give you guys a minute to vote, and then over to Andy and Vince for analysis.
We almost need the countdown music to play along while we're getting the poll results come up on that.
We'll have that next time.
I will say that so far the results are, surprising to me, overwhelmingly agreeing with the option that I also picked.
I'll just give people another minute, just in case you haven't got your vote in. Okay, I can see the majority of you guys have voted. Some votes are still coming in. Could I hand over to Andy just for his analysis on the results so far?
Yeah, I mean, as Vince said, just seeing it, it's at 73 or about 70% of soft market rates and margin pressures, which, yeah, it's kind of what we expected. But I think, in all honesty, it's not just one thing that's happening in isolation with this. If you look at things like the soft market pressure, you've got the regulatory expectations, you've also got capacity scrutiny. They're all converging in one place, and that's primarily it's going to be in pricing. I think, yeah, looking at these results, what we're seeing in the market is that MGAs can still grow in a soft market. I don't think that's necessarily the challenge, though, but they can grow in a way that quietly erodes margin. And I think that's what's pushing up to board level. At the same time, if you look at some of the options on there, you've got capacity providers asking much tougher questions now. I don't think it's longer just why are you growing? It's more, can you prove how you're pricing and why that performance is also sustainable? Then if you start laying in whatever else we've got in there, we've got the consumer journey and fair value expectations as well. It's not just a set a price, you've got to evidence of fair value as well. And suddenly pricing becomes something boards need to have some real visibility on. So regardless of which option, albeit very heavily with the soft market race in this poll, in reality, I think it's a combination of all of them together that's driving the shift. I don't know if that's the same with you, Vince.
I think that just looking at the first option that everyone sees from their own perspective as being the top item, really price is the single biggest thing that everyone has under control in their performance in the market. So you want to be able to price in such a way that you will be able to win the business that you need to win, but you also need to understand what customer behavior looks like and elasticity, so that you are not pricing too low to be competitive, because there's usually some point where you can price a little bit more highly and still be able to win the business, showing that you can prove your value. And that brings in everything that Andy just talked about as well. The need to be able to be transparent about how you set a price, because while you may not be setting the lowest price, you need to be able to still prove the value that you're bringing with a slightly higher price. And then consumer duty is what's driving that as well. So in order to do that transparency and be able to report on that, you do need everything else we've talked about here in this particular poll and everything that Andy's just brought up around being able to be transparent, being able to have data governance so that you know exactly why you set your prices, and also provide the information that your capacity providers need and also your regulators.
Okay. Thank you. That sets up my first question very nicely, actually. So I wanted to look at why you both thought pricing has moved from a technical function to a board level issue for MGAs in 2026, taking into account the drivers that we've just listed there in the poll.
And so, yeah, I'll kick off if you're okay with that then. So it's kind of what I've started talking about. I think the big shift is that pricing has become the clearest link really between you've got the growth, your profitability and the risk. And that's why the board need to look at it, because that's what they're accountable for ultimately. In a soft market, you can still grow. You can grow top line quite easily because you've got increasing costs off the back of it. But what it will do is the growth can mask any margin erosion underneath, which Vince kind of said earlier around pricing correctly. So boards need much better visibility of what's actually happening beneath this. I think at the same time, expectations have changed. With things like the consumer duty, it's no longer just about the outcome, it's being able to how you evidenced around how you'll be able to show how you got there ultimately. And that introduces a new governance element that simply didn't exist in this way in the past. I think capacity providers, they're also playing a big role here. They're looking for much stronger proof of pricing discipline. It's not really just typically you're going to have your KPIs and you're just growing off your metrics, because that clearly impacts their confidence in your long-term capacity. So what you're really seeing is the board asking for much clearer MI. It's not just the kind of end result, the technical outputs from your models, but it's something that actually explains the performance, the risk, and also the decision making behind it. So I think ultimately pricing's really shift from being a back office, more technical function where you've got that corner of the room where they've got the lights turned off and kind of left alone. It's become much more to the forefront. So it's really a strategic control point. And it's where MJs are having to balance really competitiveness across compliance and also profitability all in one place moving forward.
Yeah, those are really great points, Andy. And I think that that the need to be transparent and be able to report to management what's going on and why you're doing this is one of the things that's really driving it. And as MGAs continue to have more and more influence in the insurance market, particularly in the UK, their position is really becoming more and more like the traditional insurers. When they have the power to set the price, they need to be able to prove why they're setting the price to their capacity providers. They need to also be just as clever as the actuarial departments at any of the large insurers or at Lloyd's, because we need to be able to provide the science behind why we're doing this. Everyone else is becoming more and more sophisticated in their pricing. Everyone else is employing technology in more ways. So the board needs to understand how they need to shift their overall strategy to support these changes.
I'm glad you mentioned technology, Vince, because we're going to come on to that later, because we can't talk about this without talking about technology later on. So I'm going to move on. So we are clearly in a soft market. Yeah, that is very clear. How much of this shift do you think is being driven by market conditions versus external pressure from carriers and regulators, and what specific pressures are being put on MGAs in terms of pricing, in your opinion? Could I come to Andy first?
Yeah, no, I'm happy to go again. I think it's definitely been driven by both of them. I'll say that the soft market is what's really exposing the problem more, and it's the external pressure which is forcing the change itself. So the soft market is, as we mentioned before, it's compressing your margins. There's more capacity available than it has been, which leads to more competition, and there's more pressure on the rates depending on which line of business or distribution channel you're working in. So said it's a bit tongue-in-cheek. It's never easy to win new business, but perhaps it's easier to write business, but it's harder to write profitable business, which is the ultimate goal. I also think if you step back from the MGA and you look at the carriers, they're asking, again, it leads back to transparency, but they're asking much tougher questions in this area. They want to understand not just what the prices are being set, it's really how those decisions are made and how the portfolios as a whole are performing. And then again, if you start then looking at it from a regulatory viewpoint, there's been a real shift. It's no longer just acceptable to rely on assumptions around fair value. You're always going to have the skill sets of different underwriters and then know what's happening in the market, be able to provide a load here or a discount, whatever it might be.
Can I stop you there? Why is it no longer acceptable?
Because you have to evidence it. That's the biggest thing. With the regulatory side of it, firms need to evidence why you've come up with this decision and this price, and then you have to link it back to the customer outcomes as well. And that's the biggest shift. You can't kind of come up with a price and then decide how you got there afterwards. You have to be very clear and transparent upfront in how you're going to address each individual, whether it be a person or a business. And I think that's been quite a big change. And I suppose following on from that then, what it creates is really a lot more challenge around the pricing decisions, and that's not just from the carriers, but it's going to be from the MGAs and the compliance teams all around it, and it's happening a lot more frequently than used to. We deal with a lot of different brokers, MGAs and carriers, and we have to do lots of review, whether it's through the professional service teams, just to understand the impacts there. So I think in the MGA market specifically, they're stuck in a bit of tension. You've got to remain competitive within the broker market that you're servicing, but at the same time, you have to protect your margin and to really demonstrate that element of control around it as well. So I think that's why pricing's effectively moved from being more of a commercial lever to something that's also, a governance requirement ultimately.
That's a really good point. Thank you, Andy. Over to you, Vince.
I think that the soft market is what everyone's focusing on again. But to Andy's point, we need to take a more holistic view and understand not only is there a soft market, when you're pricing in that soft market, if you still want to remain competitive, but make sure that you're pricing the risks properly to maintain your profits, you need to think about compliance and reporting and regulatory impacts as well. You need to be able to tell the regulators, this is why we are pricing this low or this high. And also something else that you need to think about in the soft market, while you may be thinking about wanting to grow more volume to stay in the market and be more competitive, you need to think about the quality of the risks that you are taking on as well. So it's also a matter of thinking about I don't want to say this too coarsely, but am I being taken advantage of by people that are wanting to look for a low price? Do I need to think about which risks are worth insuring versus those which might be too risky, which, I can offer a higher premium to, but will my soft market conditions allow me to charge a price that covers that? And so pricing sophistication again comes back to it, becomes a strategic issue, and we need to be able to understand why we're setting our prices for any particular entity and what the impacts are going to be.
It's really interesting that you said it's a strategic issue. Could you elaborate on that point, please?
At the end of the day, once again, the thing that you have to look at, that you have to control where you're going to be in the market is your price. And you have to be able to not only explain that price, but understand what's going into it, how am I impacting my overall market, and how are the regulators going to respond to that? Because at the end of the day, you don't want to be having additional fines or regulatory fees added into your costs. So you need to be able to understand that strategically, as an entire company, what are we doing around pricing, and how does this impact everything across the board? Because pricing ultimately drives not only our revenue, but it also drives where our costs are, how we're going, and it also drives who we're insuring, what's our profile look like, and what kind of reserves do we need to be looking for from the market that has the capacity that it has right now.
Okay, interesting. Very interesting points. So I'd like to move on to the next question. And that's going to be about pricing governance. So I want to ask both of you, how have you seen MGAs adapting their pricing governance and decision making to support regulations such as the FCA's fair value, which I'm sure we're all very familiar with, as well as transparency and sustainable performance? And what are the biggest improvements that you have seen from MGAs?
Do you want me to go? I see we've also got a
Yeah.
question. I'm not sure how we're meant to take questions in the chat. It kind of links into this as well a little bit.
Okay. We can take a quick question. That's fine.
Yeah, if you're happy to. Sorry if I mess everything up
No
by
worries.
just going off on a tangent with it. But I think it's coming through some kilo. If I said that correctly, on the apologies if I haven't. But I think it's a good question. The question here is there an expectation that different underwriters within the same company offer the same price and terms for the same risk, or is the expectation that any differences are justified in reasons, even where pricing or terms differ? I think it's a tricky one because it depends on the line of business. Some of it could be automated, therefore, with the pricing models, underwriting decisions behind it, it's a calculator, it's a decision. So same input, same response will come out. So for higher volume, if you're looking at maybe SME markets or personal lines, you would expect the exact same thing at the same point. Is likely in most cases to have the same outcome, whether it be decision or price. Where it's a little bit more complex risk, where you're going to have an underwriter looking at it, I think it's more around ensuring consistency of approach over the kind of and control as well. You wouldn't necessarily, I think, expect every underwriter to land on the exact same price or terms for a given risk, because everyone has different experiences or different thoughts that might slightly affect it, because there's always going to be an element of judgment or experience context that come into play. But I think what's expected now, particularly from a regulatory standpoint, and then if you probably look at the capacity perspective, is, as you said, as long as the differences are clearly justified, you're able to reason with them, but also it goes back to Vince's point around having that controlled kind of framework. If you've got a defined framework within that, you should be okay. So if two underwriters will take a slightly different position, I think that's fine. But as long as you can explain why, you should be. I know all calls are recorded and this is recorded, but in theory, you should be okay, because you've got consistent pricing. You've got to have the same kind of parameters around it, and you've got to have an audit trail as well. I think all of those are important, and that's where the pressure comes a little bit back onto the MGA. So I hope that helped answer that question. But let me know if there's anything else where you think drastically, okay, it's not what you're expecting.
I completely agree with Andy on this point, actually, because obviously the more complex business gets, the more you have to rely on seasoned underwriters to make sure they're making the right decisions. But as long as there's a process in place and there is reporting in place so that you can clearly delineate why there's been a difference between two particular underwriters who may have had different experiences. I think that you'll be fine either way. And again, this comes back to the regulatory pressures we've been hearing about, where people want to understand what's the transparency behind this. It gets a little bit trickier when you're using more experience around manual underwriting for more complex business, but at the same time, there should be some sort of process in place where any given underwriter can outline their reasoning for how they arrived at a particular outcome.
No, agree, Vince. So I think that kind of leads into the original question, Claire, around how MGAs are adapting to this side of it with the regulatory requirements.
Absolutely.
I think what we're seeing is quite a clear shift, where it's gone from pricing being something that's maybe reviewed not that frequently, more on quite a long gaps periodically, if I could say the word to that, but something that's being continually monitored and it's managed continuously. And I think that's the big change, with the ability to have, whether it be platforms that you can pull out more detailed and more structured MI, not just outputs from models, but actual insight into the performance of the trends of the risk or the portfolio. With it, it's come a lot more formality around the governance, I think. There's much clearer ownership of the pricing decisions, but you're going to have better approval frameworks. We've kind of mentioned in the answering that question that came through, and you're going to have proper audit trails behind all these changes, which is all coming on board. I think one of the biggest kind of improvements that we've seen is the alignments. Pricing, I made a joke about being in the corner with the dark lights switched off or everything off, because I used to work for Zurich and that was literally where the pricing team sat on that side. But they're no longer in isolation or as much. I think it's being linked back much more closely around with the underwriting performance, but also to kind of finish that triangle, the claims outcomes, which is critical really for demonstrating that fair value, or you're getting the right price for whatever reason in the line of business that you're working with. I think the focus is huge really around transparency and explainability. That could be just from basic decisioning, but also actually the pricing models behind there and what that means in kind of a readable human language as well, if the FCA come knocking on the door. It's being able to clearly articulate why decisions being made, but most importantly, it's not just externally, it's also internally. If you've got pressures going to the ELT to decide why you're going into these risk areas. And I think another change over the last probably 2-3 years is really MGAs are starting to invest more in their own capability, rather than just relying completely on the capacity providers to give them kind of pricing direction. MGAs are a lot more agile typically, so they've got the ability, if they've got more control over the price and the underwriting decisions, the shift has gone from we have a pricing model really to now we have a governed framework, pricing framework, and that's I think quite a big step forward.
Thank you, Andy. Vince, did you want to add anything?
I think that evidence that the mindset is changing in the MGA segment is when Andy and I are working with new MGAs in our regular jobs. The first questions we are often getting are, how can I cap and collar to make sure that my renewal price is not higher than my new business price? Is that easy to do with what you do? What are some ways to do that? And the other big question is, how can I show the value of the premium that I am offering? How can I show that covers the risks that are insured, and that I can explain this to not only the customer, the insured, but also to any regulator or any auditor internally that needs to understand these things. So people are thinking about what fair value is, how they can demonstrate the value of the pricing that they're setting, and how they can easily explain that. So I think pricing explainability is a bigger topic that's going to continue growing. And there are more and more tools out there that can show you exactly from your existing customer database or data set, what is driving costs, what is driving risk, and how do you price against that, so you can show this is basically my costs of production, and these are the premiums I need to charge to cover those.
I agree. Just a message to anyone watching: if you did have questions, do feel free to put them in the chat and we will pick them up where we can. Okay. So I'm going to move on to my favorite question actually on AI. So AI is becoming central to pricing strategy. And it's really a tool for reinventing underwriting, with 80% of firms experimenting or planning to use generative AI. That finding was from the Earnix Trends Report 2026. So my question to you guys is, how can MGAs use AI to balance to kind of balance speed and pricing discipline, and why is this balance important? Andy, I'm coming to you first.
Yeah, you got to love AI. It's mentioned everywhere, everywhere you go. And it's always trying to think of the type of AI where you utilize it. I'm not sure if you're able to plug other organisations, but we were at a breakfast meeting yesterday with the London Market Forum. It's a slightly different area within the market, but it's a big topic there. And one of the things that came out of that was a lot of it's not just the speed and discipline, everything around it that can help. It was around having a cultural shift as well, the mindset within companies to utilize it. AI as a whole, I mean, Earnix, the company we work for, has been utilized at some point for the last 10, 15 years. And that could be just really automation or predictive modeling. But within the MGA space in particular, I think it's starting to get really interesting. MGAs are under quite a lot of pressure really to move faster in the market. They tend to have to pick up the risk that they've got the skill set for that carriers can't deal with, or they don't have the expertise or skill sets to write the correct policies and the business to bring in for them. But you have to move quickly, but without losing control. So if you start prioritizing speed without the governance, you end up with pricing drift, and ultimately that's going to create you a long-term profitability issue. More importantly, it's hard to unpick that and unwind it. So I think the balance is critical. You have to focus. You don't want to focus too much on governance because you'll slow everything down, and that creates commercial friction. So it is getting a balance. So what we're seeing is really, and we have to reference the Earnix Trend Report in this, but I think the AI is moving from really the experimental side. It's got to a point where it's more mature, and it's now moving into execution. So it's not a concept, it's actually embedded now into whether it be the pricing or the underwriting or decision workflows. You touched upon technology. I think technology and the role of it is here to enable both the speed and control within that area. So that could be things from, I don't know, it could be just basic things like faster testing. You're going to have faster deployments, those prices or decisions, but ultimately you're going to have a proper monitoring and oversight in place as well with those solutions. So things that have been around for a while but becoming more evident is automation. I think that's starting to play a big role, whether it be the whole process, customer journey to all of the modern underwriting rules and then the deployment on them, or just to segments within it, anything that's really repeatable. So rather than relying on kind of fragmented tools, manual processes, they're trying to look to bring everything together in one place. So I think ultimately the goal isn't really a trade-off of speed against discipline. It's really you're looking at trying to industrialize pricing discipline so you can actually achieve both speed and governance in there.
Absolutely. Could I just go back to your point about pricing drift? Could you explain to listeners what that is?
Well, typically, if you're looking at pricing drift, you're not aware of it. You'll have your level of margin depending on distribution, whatever setup you've got. You're going to gradually, over time, it will move away from where you want it to be, and ultimately, your margin will typically erode and get worse. So it's just monitoring it to have regular review constantly to make sure that you're pricing at the rate or making a decision at the point that you want to, and continually being in that area. So whether you're looking to expand into a market and bring in more policies, or you want to increase profitability, it could be as granular as an individual case or as a portfolio view. It's just monitoring that and controlling it, so it helps avoid that. If you're more agile, you can make more changes on a more regular basis.
Okay, thank you, Andy. Vince, over to you on the AI question.
I think that Andy really hit the point with AI will allow you to maintain governance and discipline, and also implement changes more quickly to maintain that discipline, so that you can basically see, as Andy said, as prices move, you can build an AI model that says monitor these prices and then deploy new rates within specific tolerances based on my other models as quickly as possible. And you can also use those AI tools to log all of the changes that you're making. It can also tell you why the changes were being made to meet specific business goals, so that you have that governance and that evidence ready as well. Some things I think that people need to think about with AI, though, it's not a cure-all. It's not going to be easy to implement either.
Why is it not a cure-all?
Well, you still need to have the discipline of making sure that what is being put into place is actually what you want, what it is doing what you expect it to do. You can't just ask it any question and have it and build any kind of a language prompt without thinking about what the logic of your own thought is behind building that prompt, because AI is going to do what it's programmed to do, essentially. So you need to think about how you're going to build the prompts that are actually doing the work for you. You need to review what the results are on a regular basis to make sure that they're staying within the margins and the tolerances that you expect your results to be in. And you also need to prioritize the areas that you want to target using AI. What tasks can I immediately start commoditizing and automating, and that I can take the grunt work out of having a human do this over and over again, and make sure that you're targeting these places in a logical manner that allows you to stay competitive. And I think an important part of that is understanding who your partners are that can help with that. Using AI is not as easy as people think it is. You need a lot of discipline. You actually need a lot of technical expertise to be able to implement it properly. And so it's important to also think about who you're going to work with that's going to help you do these things.
Yeah, absolutely. So the right partner is key. Interesting. Okay. Do we have any more questions at this point?
Okay, we've had one that's come through directly to us that looks at, again, keeping in the same vein as AI. It might be that you've covered some of these in particular, but it could just to get a summary if not. But AI-driven pricing models, obviously, we know that they're facing kind of growing regulatory pressure. But how could transparency and explainability of these models be improved? It'd be good to get Andy and Vince's thoughts on this for our audience.
Do you want to go with this one, Vince?
I can start off with this one, Andy, if you don't mind. There are a number of different tools that are available that are AI driven that do provide explainability tools. One of the most common things is something called a SHAP value, which essentially it's a complex mathematical form algorithm that basically gives you a number of your different factors that are impacting your pricing based on your risks, and it can tell you which of those factors, whether it's to use a motor example, it could be driver age, it could be driver location by postal code, something like that. But these are the things that are driving the costs of your overall portfolio the most, and you can drill down into those. It's possible to build AI models that can, or rather build AI routines that do the same things, and basically are able to look at your overall data set and do the analysis of that data to make sure that you're seeing where are my risks coming from, which of my segments do I need to improve on, or do I need to think about how I'm insuring. So that's just one example on how we can use AI to analyze data and understand where are my risks, what's driving the explainability, and also to Andy's point earlier about what do I need to do to improve that margin so that I'm not drifting too far away from my original goals.
Thank you, Vince. Andy, did you have any thoughts on that?
I think Vince kind of covers the bulk of it. One other area I suppose that could come up is, especially in the more complex risks, is when you're using incomplete data, or there might be inaccurate data that's coming in because of whether it be a proposal, which could be, well, handwritten, depending on it, or there's always got to be elements which can't be structured. I think that's always going to be one of the kind of practical challenges with AI, because even the best models that you have and you start utilizing won't perform well if the data or the inputs is right. So I think, yeah, Vince covers the bulk of it, but it's interesting to see how you can utilize AI to get data to a level which is easier to utilize in your models or your decisions moving forward.
Okay. Thank you. I can see.
Sorry, yeah, go on. Go ahead, Claire. I'm not sure if you'd have seen the one come through the chat, but
yes, I've just seen it. Question for both the panel and attendees: what level of information are you providing to your boards on pricing?
I mean, so we provide a tool that allows you to provide any level of granularity of reporting. So that ultimately depends on the appetite of information that the board itself is looking for. So if they want to, so it depends on, again, it depends on the MGA, it depends on the board themselves. But if they want to know granularly to the individual postcode, what's the most risky area of the United Kingdom, we can do that. Generally, we want to be a little bit higher level than that. They might want to know which segments are proving to be the biggest drivers of cost, or which segments might be the most profitable. And we can provide that level of information because we're able to take any look at your data and segment that according to any. I mean, segment is just kind of a weird term because we tend to think of it demographically, but it could be any level of data that you have, whether it's number of vehicles, location, age of the insured, number of properties owned, whatever you define that segment as, we can group that into as many buckets as you want or get as granular as you need to. And so that depends again on what the board expects to see and how you want to report to them.
Thank you. Andy, did you have any thoughts on that?
No, I don't think there's anything really to add on that. It's just around the functionality and capability. But anything you put in, you can look at this in much detail and pull out and present. It depends what your ultimate goal is and what the board wants to see and how you want to present it. But there's no restriction in terms of the information that you can pull out.
I guess this kind of goes back to my point earlier about AI not being a cure-all. You still need to have the judgment to know what the board wants to see, and then use AI to produce the results that are on the level that is expected for your reporting.
Absolutely. Absolutely.
We've had another question come in. Yeah, I've just got one come through. It's quite a long one, so I'll read it out for the panel actually. You reference regulatory bodies. No, please don't apologise. It was more just to let the panel know that that there's some listening to do, but it's a good question, so please don't apologise for asking. You referenced regulatory bodies and consumer duty requirements justify pricing and represent fair value for the customer. Obviously, I completely agree with this. However, we want to primarily focus on property owners' business, and have seen in the soft market there seems to be a fight to the bottom, predominantly from the composite markets. Seeing this on a daily, weekly basis, where markets seem to be fighting against each other to be the most competitive, for which for the type of business we're right. Sorry, price seems to be number one factor in the making decision. I can see you both nodding there, so obviously it's resonating with you both. The question, I suppose, to kind of summarise is, how do these markets justify, from a consumer duty and fair value and regulatory perspective, their pricing and rate reductions are happening so frequently and in some cases very drastically? A really good observation and question there from Joshua, so thank you.
Yeah, I'm happy to try and answer. It's quite a long question, so apologies if I miss anything out of this. But yeah, what you're describing there is what we're seeing not only across your lines of business, but across quite a few lines of business. At the moment, there is in certain higher volume, perhaps, markets, there's a real race to the bottom kind of dynamic that's in parts of the market. And this is really where you've got strong capacity and it basically got more intense competition. And you're right, in those scenarios, price often becomes the kind of dominant factor for a customer decision making. As you all know, you get people, when I used to work in a brokerage, they'd walk away for literally £2-3 a month, and you think that's crazy, but that's the way it was at some points. But I think the key point on this is, just because prices are going down, it doesn't automatically mean firms are failing or falling foul of the kind of fair value expectations. I think from a kind of regulatory perspective, the question wouldn't be more around, I suppose, if prices are going down, are the prices still aligned with the value that's being delivered to the customer? So one way that they're probably looking at it from a viewpoint is, if the insurer or the composite insurers can demonstrate that their cost base supports the reductions, their risk selection or appetite is appropriate, I think it's another one. And then if the product that they're delivering or selecting still delivers a fair value relative to kind of the price, even though they are cutting down, I think in principle you can probably justify those movements in price. It doesn't make it easier, especially when you've got different product, different distribution, you're competing against these. I think this is where it may becomes more challenging, when the pricing begins to disconnect from the underlying risk or the cost, where people are maybe subnetting or whatever they're trying to do, and they can't clearly evidence while those reductions are happening. I think now that you can do, so if you do get that, the dreaded FCA coming in, they want to look at a batch to understand what's happening there, you can clearly identify what it is. But if people are really taking the bottom out of the rates and they can't prove that this is actually aligning with those 3 points that I mentioned around the value, the product and the price aligning properly, I think that's where they're going to come unstuck. And I think the other dynamic really is here, it's around the sustainability. You're always going to get different parts of the market, like a soft market. So you're going to have more aggressive pricing, and you can win market share. Depends on the line of business. You don't often see portfolios being kind of cross-subsidized as much as you used to maybe 10, 15 years ago. But if it's not supported by the kind of underlying performance, that it tends to be corrected quite quickly in the market. So yeah, so you're kind of seeing the split. You've got some players leaning into short-term competitive, and you've got others being more disciplined, and you're kind of looking at that long-term value, more focused on the long-term portfolio performance. But ultimately, from board or kind of regulatory pressures or perspective, it just comes back to evidence and control, I think.
Joshua, I think this is a great question, and I'm going to answer it a little bit from a different perspective than Andy just did. And that is, if you have the proper tools in place to set your technical pricing, you should be able to audit every individual quote that you've given out into the market and be able to show exactly where that price came from, what the underlying assumptions were for it, how you simulated to get to those assumptions, what the underlying pricing structure was that allowed you to arrive at that technical price. The wrinkle, so that's very easy to satisfy the consumer duty on any given quote. You should have that historical audit available for the technical price. Where the wrinkle comes in now, I think, is with more complex property policies such as property owners, where you have some post-technical price leeway for an underwriter to adjust the price accordingly. You then need to have more manual discipline in place to understand what your processes look like around that manual underwriting process, so that you can document those changes. This relates very well to the first question that we had around consistency across pricing versus the ability to justify two different underwriters having a different price. So what's that process look like? You need to look at that. And then to weave that back to our AI thing, I think this is where we have some opportunities. If you're able to record these transactions, allow AI to start analyzing that data as you're going through and give you those trends that help you to also perhaps somehow build some sort of reporting around this so that you can justify it. Even if fiscally it's not justifiable, you can at least show how you arrived at those decisions.
Yeah. Thank you both. And thank you for that question. Great question. Okay, if there are no more questions, I would like to move on to the last poll. So poll number 2. Can we launch that? Okay, I'm just going to give attendees a minute to vote. So the poll question: do you think MGAs should be making more use of technology solutions to address pricing? Yes or no? I'll just give you guys a minute to answer, and then over to Andy and Vince for analysis.
Unless it's a dramatic shift, it's looking pretty heavy one way on this one.
This is where we need like the countdown music now.
Yeah.
A few more seconds, guys. I'll give you a minute to vote. I can see some of you haven't voted as yet.
Well, hopefully we didn't lose interest during the webinar and people dropped off. But...
I don't think we did.
To be fair, it is insurance, so there's always a limit of how exciting you can make it.
Insurance is very interesting.
Yeah, I mean, I suppose we could talk to is it's probably going to cover the bulk of them at 100% the moment on there. But I think it's a good question, really. I don't know. It's probably less whether MGAs should be using technology. It's more probably a mix of how effectively they're using it. A lot of MGAs already have some form of technology in place, depending on the line of business. I mean, you can have heavy players which using a heavy Excel, but even within that, there might be some there's ways to deploy the rates or working on that analysis within it. But quite often what you find is it might be fragmented, or there's lots of heavily manual pieces. So you're getting all the board rows coming in, you're having to do a lot of work in there, which I know is a nightmare for a lot of people still on that side. Or it's not really designed for the kind of level of governance that we've been talking about, or the agility, especially mentioned with property owners' question previously, the agility really that you need or required for the market. I think what we are seeing though is probably, if you take a step back outside looking in, we're probably seeing more of a shift towards integrated platforms. And it's where you're looking at where you're going to be able to review your pricing, your modeling, your deployment, and then you can monitor it all in one place. And I think that's where a lot of the investment is starting to shift, or considering these transformation processes, because what it's ultimately going to do, it goes back to what we said quite a few times now, it enables both the control and speed around it. So I think whether it's fair value, you've got the carrier scrutiny, you've got the soft market kind of market pressures on there. Technology with it is going to be the enabler. So I think it's going to allow MGAs to respond a lot more quickly to the challenge. It could be a new market that you want to go into, or actually you think, hold on, this is burning my book massively, I want to step out of it. But you can analyze, view, and react a lot more quickly, and also it's more scalable. We are seeing with technology advancements in some MGAs where they've got set lines of business, they're now having multiple capacity providers rather than just more traditional, just one feed net, so they can then really highlight and show the risks using technology to say, okay, we think this is a good market. Okay, carrier A might say, no, we don't want that, but they can prove that it's profitable, or something looking for carrier B and C. And we're seeing quite a big change in the market from a technology helping gain capacity. Yes, it's all about maturity now with the adoption that they've got.
Yeah,
Thank you.
Completely agree with Andy. It's more on the how you use technology. I think it's a given that everyone needs to be using technology more. And one place where I think we could leverage technology a little bit better is around the manual underwriting piece. How can we get more data around what's being underwritten? How can we help the underwriters make better decisions, or more consistent decisions, or more informed decisions, I guess? And how can we help their decisions form simulations over, so that when they choose to insure a particular risk, can they see how that's going to impact an entire portfolio that the entire MGA might have, and how that's going to ultimately impact the capacity providers as well. So yes, again, it's more of how can it be used and how can we leverage new technologies. Everyone's using more and more sophisticated techniques, so you need to start thinking about how you're deploying your technology so you can maintain your competition.
Absolutely. I had a follow-up question to that. I just wanted to ask, do you think the MGAs that don't make use of technology might get left behind?
It depends on it's quite a broad topic. It depends on the line of business you're going to have in the area market that you're working in. I think ultimately, yes, they may risk being left behind to a degree, because you have to be able to have that pricing framework in place to understand the risk. As we said, transparency, etc. on that side, it's something it needs to do. And if all your competitors are a little bit more agile, or even if you look at, say, the life market, for instance, it's a lot more behind, say, than the kind of P&C and specialty markets in certain elements. But if you're not starting to adopt new technologies and understand, you can look at your kind of capital reserve or your solvency requirements within it, and it impacts that on one instance. So it's just, if you don't adopt it, you will gradually get left behind, because people can move quicker, analyze better, and then deploy the kind of business decisions they need to in that market a lot faster than you. So there is that risk. I know I waffled a bit there, Vince, but anything from you?
No, I think that the way the world is moving right now, if you don't properly employ technology, you will get left behind. It's a very competitive marketplace. Everyone is doing new and more sophisticated things. So they need to understand how they can use technology to select better risks to insure, and to justify what risks they are taking on, to make sure that they have the reserves and the premiums coming in to cover those things.
Absolutely. Well, thank you, guys. So I have one final question, and I'd like concluding thoughts from both of you. I would like to ask, if you were advising an MGA board today, what would be your top priorities to strengthen pricing over the next 12 months?
Let's go. I think if I was advising an MGA board today, you'd probably have to focus on a few key areas. I think one would be, you've got to build, we've mentioned quite a few times now, a proper board level pricing framework. It's something that has to clearly link the strategy, the governance, and the performance together, rather than, as we mentioned before, treating it as just a silo, whether it be pricing or underwriting, just keeping them completely separate. It needs to be together. Secondly, I think you've got to improve your analytics, the pricing MI behind it, because without clear visibility of profitability or any really portfolio trends, it's going to be really difficult to make any decisions, let alone make any informed decisions as well. And finally, going to the explainability piece, there's a big focus on evidence. You've got to be able to demonstrate fair value in the right markets and support all of the kind of decisions or pricing decisions made with proper documentation. So I think I would say you've got to reduce reliance on your manual processes is another priority you might want to look at as well, because that often is where inefficiency sits, whether it be data pieces. It becomes fragmented if you've got lots of different areas, manual processes within there. And you've got to have to say transparency with your capacity providers is also becoming massively important or increasingly important. You've got the MI that I mentioned with better reporting, you've got clearer insights, but it helps build trust and it supports that kind of longer term relationship. And then the final one, which kind of underpins all of that, is investment in the data and analytics, because that's what ultimately will enable faster and better decisions. So if you can move to more towards, as a board and a company, towards continuous monitoring rather than just periodic reviews, and focus on sustainable profitability, not just going to the bottom of the rate for short-term competitiveness, I think that's some of the areas I'd want to focus on first.
Thank you, Andy. Vince?
I think that this becomes a board level item, because to do those things, as Andy ended off with, you need to look at your technology stack. What do I have? Where's my data sitting today? Where are my inputs and my outputs? What do I need to get out from an analytics standpoint? How can I consolidate things as much as possible so that I have as close to a single source of truth as I can get, so that I know when I have made a pricing decision, what were the factors I used to influence that pricing decision, and how can I reproduce those results at will to show any regulator or any auditor or any customer, this is why you got the rate that you got. These are the underlying assumptions, and this is how I'm able to prove the value that I'm offering towards that premium.
Thank you. So I'd like to finish there. I'd like to say thank you to our wonderful panelists, Andy and Vince, and thank you to everyone who attended, and thank you to the MGAA. And obviously, if you did have further questions for Andy and Vince, do get in touch with the team, and they will be at the MGAA conference in July and at the Earnix Accelerate Summit in September, if you haven't signed up as yet. And a full recording of this discussion will be available shortly. I'd like to hand back to Manveen now from the MGAA.
Thank you, Claire. Thank you, Andy, and thank you, Vince, for your time. I'm just going to echo really what you said there, Claire, just thanking all our members for coming along and listening to today's session, but also, our member Earnix for giving up their time and for Lysander's support in delivering this session. We'll get the recording out as soon as we can, but if you do want to share feedback, please do. I can see that Jess from Earnix has shared some details if you want to get in touch with the Earnix team directly. If you want to share your feedback with the MGAA, you can also do that via the link I've just dropped in the chat. Otherwise, all that's left is to wish you all a lovely rest of day, and thank you all for your time again.
Thank you.
Cheers.
Take care, everybody.